Welcome to the Independent Advisors Podcast, where we dive into the world of stocks, tradable markets, and financial planning with Jessup Wealth Management's Chief Investment Officer, Mark McEvely, and CEO, Matt Jessup. You'll hear tips, tricks, and strategies to address your financial well-being, and most importantly, conveyed in a way that everyone can understand. Here are your hosts, Mark and Matt.
Hey everyone, welcome to episode 259 of the Independent Advisors Podcast, where Matt Jessup and I, Mark McEvely, bring you everything you need to know from the past week in the world of financial markets and financial planning. So good morning, Matt.
Good morning, Mark.
Ready for the shortened holiday week here that we have?
I am ready to kick off Q3 in the right way. We got Taylor on later here for the financial planning topic of the week.
We do.
I know we got some good content to kick this off.
We do. So markets are closed on Thursday, July 4th, obviously, but they are open on the 5th, on Friday.
Correct. We have an early close, you said, on Wednesday. Let's leave it 2.
Bond market?
Bond market.
Yeah, that makes sense. Any plans for the 4th, the family?
Big excitement for the Despicable Me 4 movie tomorrow evening. We have tickets. It's going to be hot.
Nice.
Yeah, everyone's excited.
Good.
Yeah.
Well, we will quickly review the year-to-date performance of the major market indices that we track, since there has only been one trading day so far in July. This data is from Y-Charts, and as of the market close on July 1st, 2024. S&P 500 index up 14.8% for the year. The Dow Jones Industrial Average up 3.9% for the year. The NASDAQ Composite Index up 19.1%. The Russell 2000 Small Cap Index up 0.2%. And the Vanguard All World Ex United States ETF up 4.6%. 3-month Treasury rate at 5.47%, the 2-year Treasury rate at 4.77%, and the 10-year Treasury rate at 4.48%. So, Matt, it's been the strongest first half of an election year, going all the way back until 1952.
Love to hear
Actually
this.
Saw this morning.
Not bearish.
First half of the year, depending on which index you were looking at, was very strong. However, you have indices like the Dow that was only up slightly over 3.5%, I think, at the end of the day. And then you have the NASDAQ tech-heavy index up almost 20% in the first half of the year. So there are certain sectors that are performing better than others, obviously, and I think it's more, bifurcated, I guess you could say, this year as opposed to last year.
I got a piece on this here in a little bit. It's going to talk about just performance of, say, the S&P in general, in one that's an equal weight index versus a market weight. And several weeks ago, when Aaron was on the podcast, we did an educational piece on how the S&P 500 is made up. So I have a specific targeted topic to really talk about how narrow participation has been. I think it'd be good education for our listeners and viewers.
Yeah, great. Well, moving on to tweets, articles, and research from this week. The first thing I had was a inflation update from the Bureau of Labor Statistics and Yahoo Finance. Jenna will throw this graphic up on the YouTube page and also in our show notes. So it's the title of this graph is Where Inflation Is and Isn't.
Good piece, Mark.
It shows the 12-month change in the price of certain goods. And at the top, you can see over the past 12 months, auto insurance has increased by over 20%.
20%.
And at the bottom, used vehicle prices have fell 9.3% as compared to 12 months ago. And this data was all as of May of this year, so a couple of months ago. But just thought it was kind of interesting to see kind of what's contributing to inflation and what's kind of taking away from it. Used cars was a big deal, new cars, rental cars, groceries at one point, but you can see that all of those have kind of come in and are now prices, or growth is slowing of these prices compared to 12 years ago. But just thought it was interesting. Restaurant meals still relatively high, housing and rent still relatively high. Which is interesting given the conversation that we had last week about housing supply, which I see you have another piece today about housing supply. So
I do, a thought from last week.
we'll see if that changes anytime soon. And then gasoline, kind of only 2% higher than 12 months ago. So we are seeing certain areas, contracting a little bit, which is a good thing. But, we still have pretty important areas like housing that are still running kind of hot at this point.
Love that you picked this. The one telling thing I see on this chart is the earnings versus the inflation rate itself. And what you're seeing is some consistent data that the consumer now has his or her head back above water from the wage gains the last couple of years versus the inflation rate. Now, is inflation going to revert back to where it was pre-pandemic? Most likely not, and I feel very strongly about that. But at least we're starting to see those wage gains are starting to be greater year over year than what we're seeing in the inflation rate.
Yeah. So just an update on inflation for everyone that was kind of wondering. So second thing I had was a tweet from Ryan Dietrich. This was back on June 6th. Again, Jenna will throw this up on the YouTube page. It'll also be in our show notes. But he says, "You are here. June, July, August are the best 3 months during an election year."
Really?
And what this shows is just the average 3-month performance during an election year. And then it also shows you the percent of the time that it's been higher each month since 1928. So June, July, August, clearly.
I wouldn't have guessed that.
No, I wouldn't have either. But obviously 3 standout months consecutively within each other. So wouldn't surprise us if this train kept going in the correct direction. Might surprise some other people that don't do this every day for a living. Mm-hmm. But even though the market has been strong in the first half of the year, it wouldn't surprise us to see that strength continue.
Correct, sir.
Last thing I had was a blog post by Ben Carlson titled "Roger Federer versus the Stock Market." And I recently just started watching the new Federer documentary that came out just a couple days ago.
Sure.
So this one, this headline caught my attention. So I don't know if anyone caught it, but Federer gave a commencement speech at Dartmouth recently.
Interesting.
And he said this: "In tennis, perfection is impossible. In the 1,526 singles matches I played in my career, I won almost 80% of those matches. Now I have a question for you all. What percentage of the points do you think I won in those matches?" The answer was only 54%. So in other words, even top-ranked tennis players win barely more than half of the points they play. When you lose every second point on average, you learn not to dwell on every shot. You teach yourself to think, okay, I double faulted, it's only a point. Federer's win and point percentage are basically the same as those of the stock market. I'm always, meaning Ben, banging the drum about the fact that the stock market is essentially a toss-up in the short term, but has a wonderful win rate in the long term.
Well said.
On a daily basis over the past 100 years or so, the S&P 500 has been flat or up roughly 54% of the time, just like Federer. Despite an average daily return of just 3 basis points, or 0.03%, the stock market's compounding over longer time horizons has been breathtaking. If Federer gave up every time he lost a point, tiebreaker, or set, he wouldn't have 20 Grand Slam titles. If you put too much weight on the short-term outcomes in the stock market, it's hard to be a successful investor.
Well said.
So 2 major things that I take away from this. So Federer won a little more than half of his points in the matches that he played, right? And I just want to throw it out there that a lot of times certain investment strategies or portfolio managers have like a 50% win rate, which is really good, actually.
Sure.
So a lot of times when you're following a specific strategy, your win rate can be 50% or even as low as 30 to 40%. But the thing you have to remember is that you're going to have outliers, right? So a year like this year and like last year, NVIDIA's been a major outlier to the upside, right? And the
Yes.
idea is that those big winners are going to pay and cover the small losers.
Correct.
But the idea is that you're having more losers, but it's smaller increments. And
That's
your
right.
Winners,
You're controlling the downside.
right. And your winners, you're letting run. So that's the first thing I took away from it. Obviously, the second thing is have a long-term mindset and don't let the day-to-day noise affect what you're doing.
Well said. I just think what happens is in this world of instant information and in this world where, the media makes money with eyeballs. I'm talking about specifically like TV. And when you are preying on the two primary emotions of an investor of fear and greed, those time horizons start to come in and be very short term. And I think it's a good reminder on this podcast to talk about pieces like this that give that perspective. It's not about what the market does this week or next week. It's about being in the market, enjoying those averages over time, and that's how you're going to achieve your goals. Timing the market is extremely hard.
Mm-hmm. Yeah, and I think you can compare this kind of to every other sport, right? You can compare it to golf. Some of the best golfers in the world hit 60% of their fairways. And they're ranked in the top 10 in the world,
Yes.
right? So you're not going to get everything right. It is not possible to predict the future or to pick every single stock that's going to go up. But if you, like we talked about, extend that time horizon a little bit, it does get easier.
Well said.
We'll turn it over to you.
All right, Mark, I'm going to kick it off right with housing. I'm going to pick up right where I left off last week when you and I were chatting. So the piece that I was referencing, Mark, was a blog post by Charlie Bolello on June 26th. This chart will be in our show notes, and Jenna will put it up for our YouTube viewers. This chart, Mark, is of U.S. new single-family homes for sale, okay? And this data point will go back to the 60s. So it has a large data set. And what it's going to illustrate is inventories and sales really coming down after the great financial crisis. And then you're kind of seeing, where that's at right now. So where we stand is the supply of new homes now, we're at 9.3 months. The next chart will be supply. And this is also going to be from Charlie on the same date of June 26th. And
what does that mean for listeners, like 9.3 months of supply? If people are like, oh, supply should be great, the number of houses, right?
Great question. So at the current number of houses for sale, at the current rate of purchases, if no new homes came on the market, they would bleed through and be all sold within about 9 months.
Got it.
Now, the reason that's important, and I'm glad you're talking about this because that's the second chart, is on average, going back 4+ decades, we're usually around 6 months. Okay. So what it's telling you is we have excess supply of homes, at least when you look in regards to history. Okay. Now, why am I highlighting this? It has to do with the fact that historically, when you have excess supply of anything, whether it's a home or a widget, and then all of a sudden, what happens to prices when you have too much supply? They tend to do what? They go down. Mm-hmm. And you really haven't seen those house prices go down at all. Last week, you highlighted the S&P Case-Shiller Home Price Index, and I believe you quoted it was up for 15 consecutive months, month over month. Now you have this data point where home supplies are literally at some of these high points. And it begs the question, if interest rates remain at this level and housing supply remains in excess compared to history, when and if are we going to have some sort of erosion on prices? Is that going to happen?
Yeah.
And this is not really being talked about, but I just want to point it out to our listeners and viewers, and I'll say it very direct now. You have a lot of homes for sale. Prices haven't come down. Rates are high. Right now, the Fed is expected to lower rates, but at a slower pace. And at what point do sellers become more aggressive in lowering prices to move inventory? And once that starts, it's a domino effect.
Yeah, and I've already seen just in our community itself that, 2 weeks ago I noticed some new houses pop up on the market just with signs in these people's yards.
Haven't noticed them before.
And they haven't gone away. And I've continued to look them up on Zillow, and they're still on the market. Whereas just compared to 6 months ago, it was gone in a week. It didn't matter what it cost, right? So, I think this is going to be interesting. And the other interesting part of this is typically when we get up to this level of excess supply, typically a recession isn't too far away. If you look back at history.
Very interesting viewpoint as well.
So, you can obviously see in this chart that it's not every time we reach this level that there's a corresponding recession, but it's
you could
more
argue the
frequent
statistical
than not
chances are high.
Yeah.
You could argue that.
Yeah.
Okay. So again, you're hearing this stuff first on the Independent Advisors podcast. People aren't talking about housing a lot right now. And, underneath the surface, there's definitely some concerning data.
Yeah.
Okay. So the next thing I want to talk about is earnings growth statistics. So a lot of people have seen the market rally, especially since November of last year. And you got a lot of ordinary investors, retail investors, who are scratching their head. How can the market rally so much? What's going on? So there was a good post by Seth Golden, a friend of the podcast. He posted this, Mark, on June 27th. And he has a chart, and the actual underlying source of this chart is Bernstein Advisors. And the chart is the percentage of S&P 500 companies with a greater than a 25% trailing 12-month net income growth. So what is that telling you? Man, there's a good chunk of companies that are growing their net income at a pretty fast clip. Okay.
Right.
So before I read this chart, before I reference this chart any further, I want to read what Seth had wrote. He wrote this on X. The profit cycle has begun to turn, and so far, in the latest reporting period, there are more than 160 companies within the S&P 500 that are growing earnings by 25% or more. I'll continue. This is now referencing the Bernstein piece, and I quote, "The profit cycle has begun to turn, and so far, latest reporting period, there are more than 160 companies in the S&P growing earnings 25% or more. The narrowing of junk bond spreads seems to be following the historical norm, that an upturn in profitability and cash flow improves credit quality, but the equity market's ongoing narrow leadership continues to act as though earnings and cash flows are scarce." Let's take a step back. When we talk about junk bond spreads, will you try to put that in plain English for our listeners and viewers?
Yeah. So when junk bond spreads are rising, that is usually a concern that there's something deeper going on in the economy that maybe not a lot of people are aware of. And typically when you get junk bond spreads spiking, stocks are typically falling. And that's just the difference between the yield that junk bonds are paying and the yield that corporate bonds are paying, or the yield that treasuries are paying versus junk bonds.
Yep.
And if those spreads get too wide, that indicates, hey, these companies need to offer investors a higher interest rate to pay them twice a year, usually,
to entice them to
buy the debt.
Yeah.
And typically when you see these companies pricing these debt at higher interest rates, it's like, okay, what's going on here? Because no one wants to buy this debt unless they're offering a very, very premium interest rate that these investors are going to get paid to hold the debt.
Well said. And when that premium comes in, what's that tell you? Wow, a lot of these companies are performing pretty good. You don't have to pay me as much to entice me. Right? And the reason I want to highlight this is you've seen a lot of people, I feel, who are questioning, hey, what are we paying for at this point? The market's at just a 52-week high, an all-time high. What are we paying for? And guess what? The underneath the surface, underlying earnings growth for a lot of S&P 500 companies is pretty darn good.
Yeah.
So I just wanted to highlight, it's not just 5 or 6 names where they're driving the S&P 500's actual bottom line performance. You have more than 25%, 160 names of the S&P that are growing earnings by 25%.
Right.
Year over year.
Yeah. That's a nice thing, right?
Pretty interesting, huh? So on that same wavelength, my last piece, Mark, is a chart that Charlie Bolello posted on July 1st. It's a chart of the S&P equal weight versus the market cap weighted index. I normally don't say this on the podcast, but since we just did it a couple of weeks ago, for our regular viewers that heard me and Aaron talking about the differences between the Dow and the S&P, this is going to make a lot of sense because you're seeing if you were to equally weight, and I believe there's 503 names technically in the S&P, Mark. Does that sound right, sir?
I think so, yeah.
So if you equally weighted those 503 versus the market cap weighted index, this is the chart that you're going to see, and this goes back to 1973. And what this chart is illustrating, and Jenna will put this up on YouTube, this is in our show notes, is you have the equal weight index that is literally at a deep low point compared to history when you look at this chart. And you have to go back to the tech bubble of 2000 to see such a performance spread. Now, I got a bonus chart I added this morning because I saw this last night. This next chart is from Ned Davis Research, and the date on this chart, Mark, I believe is the 28th of June. It is. And it says, quote, percentage of S&P 500 stocks outperforming the S&P over the calendar year. And we're literally at the lowest point back to the early 70s. And it's, again, another data point pointing to the fact that the stocks that are really pushing this index is a very, very few limited number of names.
Yeah, I just think, this has been something that's been, in my opinion, not an issue, but an issue within the media is that there's only a handful of stocks driving the market's return every single year.
Not to this degree. I think when you look at history is one of my points.
Right. But, you can obviously see in this graph that more often than not, since 1973, the equal weight S&P 500 outperforms the market cap weight S&P 500. But throughout that period, there are spans of several years, like, 93 to 2001, from 04 to 2009, and now from 2012 through 2024, where the market cap weighted S&P is outperformed. So it's not the first time that only a few names have kind of bolstered the index higher.
Exactly. And the main point I was going to make at the end here, and it's perfect timing that you say that, this is not something, in my opinion, that can be easily timed. Mm-hmm. This phenomenon of narrow leadership can continue for an extended period of time. Mm-hmm. It could end in a week.
Yep.
And so I want to give caution that I'm starting to see more clickbait in the market about calls for, timing of the end of this narrow leadership.
Right.
And I think that is going to be very challenging.
Yeah. And while you were speaking on some of that, I pulled up current S&P 500 constituents, and it's no secret that Microsoft and NVIDIA are the two biggest components of the S&P 500.
Correct.
I'm going to give you 5 guesses to name one of the bottom 3 weights in the S&P 500 right now. So what are those 3 names that make up the tail end of the S&P 500? I'll give you 5 guesses.
Does it work if I know that one just got added?
Sure.
I know CrowdStrike just got added, but it probably is already not in the bottom.
Yeah, it's not in the bottom.
And again, these are not recommendations for or against any of these names. I honestly do not know. Trying to think of something that's really, really underperforming. Like Walgreens is really underperforming right now.
They already got kicked out. I think it was the last rebalance earlier this year.
All right. Give me a second. Give me one more. Give me one more try here. I'm thinking hard.
I'll give you a hint. Think of TV.
Discovery.
Nope. Close.
Liberty.
Nope.
Definitely not Comcast. They're too large. Charter.
Nope.
Okay, I'm out.
You're out.
I'm out.
The smallest company in the S&P 500 is News Corp.
News Corp. Okay.
Second to smallest is Fox, which is they've had a fall from.
I know
grace.
that. I know that all the medias are really
Right.
struggling.
And third from the bottom, Paramount.
Interesting. Man, I remember how integrated Paramount was, 20, 30 years ago. They were in so
Yeah.
many things. Kings Island.
Right.
They had so much stuff.
So, a couple other names that people might be familiar with that are kind of in this bottom tier of the S&P 500 that you would expect at some point will turn around and outperform, where the heavyweights take a little bit of a breather. Ralph Lauren, Etsy, American Airlines, Hasbro, DaVita, Norwegian Cruise Line Holdings, Caesars Entertainment, Match Group. So names that have pretty good notoriety, but they have not been treated well as of late.
Yeah. Wow.
So,
That
anyways,
was fun. That was fun.
Yeah, no, it's always interesting to compare equal weight indices to market cap weighted indices, and people have there's certain takes on what's better, what's worse. But
that's what makes a market.
Yeah, it is. Yeah, everyone's different opinions. So
That's what makes a market.
well, I'm going to hop off here, let Taylor come in for the financial planning topic of the week. Hope everybody has a wonderful 4th of July holiday. Stay safe, enjoy the weather, and we'll be back with you next week.
Thanks, Mark. So coming up next for our newer listeners and viewers, after we discuss what's caught our eye over the past week, we usually highlight a financial planning topic of the week. And we try to have our practices paraplanner on for this section, Taylor Ledbetter. Taylor, welcome to the podcast.
Thanks. Good to be back.
You have big plans for the 4th of July?
Just going to go see fireworks with some friends.
Nice. The fireworks, where do you go in town? Where do you like to go?
I always go to Delco.
Yeah, I like going to Kettering too. They're always great, aren't they?
They are really good.
They're
Just
really, really
a lot
good.
of people.
Lots of people.
Yeah.
So my trick is the church that we attend is not too far from there. And of course, it's a little bit of a longer walk. But the nice thing is the minute you get back to your car, you can get out like instantly. So I'd rather, do that extra 5-minute walk so I'm not sitting in the traffic.
I agree.
Make sense?
Yeah. Last year when we went, it took us an hour just to get out of the parking lot.
Not surprised. It is always just those bottlenecks. And of course, with my kids, leave it to my youngest, my daughter. She is now trained that if I pull her, we have like this cart that you put all the goodies in. Of course, it's too much of a hassle for her to walk. So, she always has to have her spot in the cart that I pull.
Oh my
She knows how to work the angles with Dad.
Oh yeah.
Knows
That's
how to
so
work the
funny.
angles. So what do you got for our listeners and viewers this week, Taylor?
Yeah, so today I'm going to be referencing an article that I found on Kiplinger.com.
Oh, great.
And it's called What's Going On with Social Security and How Concerned Should You Be?
Well, this is a hot topic these days, especially a presidential election year.
I know, and I know you kind of talked about this a couple of months ago. So today I'm going to talk a little bit about some of the solutions,
Okay.
but I'll focus more on like the history and why it's becoming problematic right now.
I'm looking forward to this. Okay, turn it over to you.
So I'm just going to start out with a data point. So the article says in 2023, benefit payments totaled $1.1 trillion, which was nearly a fifth of federal spending. Revenue ran short by about 3.7%, which forced the Social Security Administration to tap $41 billion from its $2.7 trillion trust fund. So I think that's, definitely a reason this has become a hot topic is because the trust fund was just reached into starting last year.
Yes.
So the last time Congress undertook significant changes was during the Ronald Reagan administration. So from 1935 to the early 1980s, basically just enough taxes were collected to pay out Social Security benefits. There wasn't any sort of trust fund during that time period.
Yeah.
But it wasn't until the 80s that Congress mandated that workers pay more than needed to build up that trust fund. And obviously, the funds are invested in treasury bonds that earn about 2.4% in interest on average.
Made sense. I mean, at least in the 80s, Taylor, they were looking at demographics. And then with the baby boomers, at some point, a big chunk of society was going to retire within, a decade and a half, period. So that was good foresight for them to do that.
I agree because, my next point was that, obviously 401ks weren't really a thing.
They weren't back then. No, it was all pensions.
Yeah. In the 80s, that's when, corporations kind of started that transition from the pensions to the 401k plans.
Correct.
But something that I thought was interesting was that from about 1937 to 1978, the Social Security tax increased from about 1% to 5% over that time.
Interesting.
So a lot smaller than what it is right now.
Yeah.
So just a little bit of history on kind of what happened to Social Security and why it is becoming an issue now. In the early 80s, the congressional recommendation was that 90% of all salary and wages be subject to the Social Security tax. That rate slowed down over time, and now only about 82% of all salary and wages are taxed today.
Okay.
And then I thought this was just an interesting little quote from the article. It says, the formula that the Social Security Administration uses to calculate the maximum pay subject to the payroll tax did not anticipate an economy in which professionals with salaries already above that taxable income, which is $168,600, would take a bigger slice of the national wage pie.
Yep.
So in 2020, for example, 63% of the money paid out in raises went to about 184,000 people making $1 million or more. The average raise for those individuals was roughly 84 grand, none of which was subject to the Social Security tax. The average pay raise for the other 167 million workers was roughly $570.
Yep.
Again, this is from 2020.
Mm-hmm.
As a result, most of the increase in overall wages has not been subject to Social Security taxes, placing a further drain on the money available to pay benefits. So IRS data shows that wages and salaries accounted for about 78% of national income in 1993, but only 61% in about 2021. The rest came from increased business profits, capital gains, dividends, and some royalties, again, none of which are subject to the Social Security tax.
Yep.
So I thought the history on that was pretty interesting.
Very.
And the income, differences from the 80s until now, because of course it does make a lot of sense.
It does. Plus people living longer.
Yeah, life expectancy increasing.
Yeah.
All of that.
Yeah, absolutely.
And then the article had a couple other solutions to the Social Security problem that you didn't cover in the podcast you did a couple months ago about this.
Okay.
So I wanted to point those out. Thought they were pretty interesting. So this first solution, it is privatizing Social Security. And I wanted to bring this up because I do get questions pretty frequently about, will Social Security be around by the time I retire?
Mm-hmm.
And I think this solution or potential solution I'm about to talk about helps answer that question.
Okay.
So obviously Social Security pays out to retirees a lot more than it currently is taking in. So in order to maintain current benefits, any diversion of taxes to private accounts would have to be made up some other way, presumably with a new tax law. So any Social Security tax money flowing into investment accounts would have an enormous impact on the stock market.
Yes.
Consider the effect of pouring an additional $200 billion or more into the market each year. Share prices would likely inflate, creating a market bubble that might then eventually collapse and take retirement funds down with it.
Definitely a potential issue.
Yeah. So this solution was originally recommended by President George W. Bush back in 2005. I don't think it's gotten a ton of, looking at for that reason.
Yeah.
And then, of course, the article talks about raising the retirement age, raising the current tax rate, which is 12.4%, half paid by employee, half by employer.
Correct.
I won't touch too much on those because I know we covered them a couple months ago. And then raising the income tax cap.
Yes.
So again, that tax cap is $168,600. So income over that doesn't pay Social Security tax. But an interesting quote, this is from Nancy Altman. She worked on the 1983 commission staff. She stated that raising the cap on taxed wages to $250,000 would be a substantial step in securing Social Security's long-term future. She adds, why not apply the tax to all wages, including the 504 highest paid employees, whose average pay in 2021 was $151 million each. The strongest argument against this idea is that some retirees could collect more than $1 million annually.
You're going to get it the other way, right? They pay into it. They're going to get large payments down the road.
Exactly. Because like I said earlier, what's being withheld now is what's being paid out now.
Correct.
So that would be a lot of money for, the working class to withhold. Mm-hmm.
Especially if you did those quote unquote 504 highest paid employees, they'd be getting some pretty substantial Social Security payments. And I think the most realistic outcome, and this is maybe not going to be a popular opinion, I think the most likely outcome is some sort of needs-based calculation. And there'll be some sort of formula that if your income was X the last time you filed your taxes, whether it's single, married, filing jointly, had a household, etc., you get 90% of your benefit, what was said. You get 85%. I don't think there'll be substantial haircuts, but I could foresee that is where the puck is going, in my 2 cents.
I would agree with that. I think that's probably the most realistic option.
I think it'll be a combination, Taylor, of that, and I don't disagree that raising the tax cap is a politician's friendly option, right? When you have the narrative of, well, I'm just going to tax the rich to fix this problem. And, the only rebuttal I have to that is those 504 highest paid employees that are averaging $151 million each probably have teams of accountants that are helping them minimize their tax bill.
Sure.
And I'm sure they're going to get creative legally.
Yes. Yeah.
That's my 2 cents.
I completely agree with that. I think there would be a lot of pushback with that. Kind of adding to what you said about making it more of a need-based program, I think that would cause the least amount of waves for everybody.
I agree. I agree. And it's almost like what they did with Medicare. So I know you talked about it on the podcast previously, but if you're a retiree and your income's really, really high, your Medicare-related premiums could be elevated compared to somebody else, right? And I think that is along that same wavelength.
Yes. The last solution that this article talks about is ending the Social Security tax. So it says making benefits tax-free would reduce income tax revenues by about $47 billion, a sum that would be more than offset by imposing the Social Security tax on all pay. So up to 85% of your Social Security benefits are taxable.
Mm-hmm.
And I agree, removing that would definitely help with that offset, but I don't think the IRS would like that too much.
Yes.
And then, of course, there might still be some type of other tax law that has to be enforced, potentially.
Makes sense.
Yeah.
I'll be curious. Obviously, we're in a presidential election year, and you're hearing a lot of topics surrounding Social Security, a lot of ideas. And I know this will be probably in the top 5 or 6 considerations for people voting this upcoming fall, especially for the demographics of, when you look at the numbers, the older you are, the higher chances you're going to the voting booth every year, right?
Right.
And obviously, people who are drawing Social Security have a vested interest to ensure that continues. Politicians know that. So I definitely know it'll be a hot topic on the campaign trail this year, right?
Yeah, definitely. I think that's why we've probably both gotten a lot of questions about it.
I'm glad you highlighted this. I would encourage you as the year goes on, so listeners and viewers can hear me say this, if you get any other sort of updates or speculation from some of the prominent people running, i.e., Biden or Trump, definitely, add that to one of your financial planning topics of the week. Say, hey, this is the proposal I'm hearing. This is the potential, what that would mean for the recipients of Social Security. One last thing. If nothing changes, Taylor, the trust fund runs out sometime in the mid-2030s. Does that sound right?
I think the end of 2034-ish. Something like that.
And they would have to raise more tax revenue to fill the deficit. Good way of saying it?
Yeah.
Okay.
Yeah, I know raising the Social Security tax rate right now, they've talked about bringing it up to about 15%. I don't know if that's what
how
they're
much
leaning
longer they would
towards.
extend it.
Yeah, I'm not sure.
Well, thank you for highlighting this week.
Yeah,
It's
you're
a
welcome.
Great topic, Taylor. So before we end, a couple reminders for our listeners and viewers. First is, if you want to create your own podcast, we use Blueberry as our podcast hosting site. You can use the promo code JessupWealth to get your first month of Blueberry podcast hosting for free. To choose the ideal plan for you, use the hosting estimator on their website. Again, you'll receive your first month for free using the promo code JessupWealth. That's all lower cases and no spaces. And also, if you're looking for an AI software to help you note take and summarize a meeting, we highly recommend Firefly's AI software. You can use the link in the show notes below to purchase your subscription and make life a little bit easier. As we sign off from episode 259 of the Independent Advisors podcast. Any final thoughts, Taylor?
No, just everyone have a great 4th of July and stay safe.
Yep, be careful with those fireworks.
Yes.
Stay safe, everyone. Have a good week. We'll see you next week for 260.
Thank you for listening to the Independent Advisors podcast. If you're interested in hearing more, hit the subscribe button so you can be notified every time a new episode gets released. Feel free to share with friends, family, and follow us on Twitter at Jessup Wealth, Facebook, and LinkedIn. Mark and Matt will continue to share beneficial information on these social media sites. Also, check out the podcast tab on their website. That's www.jessupwealthmanagement.com. There you'll find links to every episode of the Independent Advisors. Have questions or topics you want to discuss on the show? Message us on Twitter, LinkedIn, or send an email with the words questions and topics in the subject line to inquiries@jessupwealthmanagement.com. We'll talk about it right here on the podcast. Certain sections of this commentary may contain forward-looking statements based on reasonable expectations, estimates, projections, and assumptions. Forward-looking statements are not guarantees of future performance and involve certain risks and uncertainties which are difficult to predict. All indices are unmanaged and are not available for direct investment by the public. Past performance is not indicative of future results. This podcast is provided for general informational purposes only and does not constitute either tax, legal, or financial advice. Although we do go to great lengths to make sure our information is accurate and useful, we recommend you consult a tax preparer, professional tax advisor, financial advisor, or lawyer regarding your specific circumstances. Investing involves risk, including the loss of principal. No strategy can guarantee any objective or goal will be achieved.